about asset allocation now. In the Joburg studio is Tristan Hanson from the organisation Ashburton, and he's head of asset allocation there. Tristan, thanks very much for joining us. Welcome to South Africa. Hopefully you can get out of Joburg soon and come to Cape Town. But no matter where you are, let's talk about asset allocation and talk about markets in a changing world. And changing markets are interesting. You see the Nikkei Dow over the last 3 to 4 weeks doing extraordinary stuff. The Shanghai index rising, the JSE every single day almost going to all-time record highs. You have to be quite nimble, I suppose, as an asset allocator with all these sort of divergent performances.
That's right. I mean, it's interesting looking at what's happening in the world, as you point out, because, you know, for a large part of the year, various emerging markets such as China have underperformed the likes of the South African market, and yet we've seen in recent months, actually, the Asian equities have picked up quite nicely at a time when the US has come off. So more recently, we have seen a bit of a divergence in performance between some of the country performance.
Yet you talk about how we're faced with this changed economy and how that's making you uncomfortable, nevertheless, because what this means is adapting to an age of low yields and potentially low returns moving forward, no matter what the markets are doing right now.
That's definitely true in the fixed income space in developed markets. It's not necessarily true across the world as a whole. I think one thing that is different, though, from the past is that if you're a very risk averse and a very nervous investor, then maybe you'd feel happy to plonk some money in UK gilts, US treasuries, German bunds, etc. And maybe in days gone by, you might get a 4 to 5% yield in those markets, and you would be happy with that. Today, as we know, interest rates are extremely low, or effectively zero in most of the developed world, and therefore for the very risk-averse investor, they're faced with the unappealing prospect of zero effectively on cash, or what has been viewed as safe haven government bonds. So to get a return, in a way they have to, if they want the return, to embrace additional risk by looking at other markets or equities, other assets.
Tristan, having a look at the currencies markets, we talk about super low interest rates and ultra easy monetary policy worldwide. So the major currencies are sort of on the same footing. But I noticed this morning euro dollar breaking 129, and that's ahead of the US non-farm payrolls figure, which is that monthly event that everyone seems to look forward to. I think the whisper number is something like 115 or 120,000 increase in jobs for the world's largest economy outside of the agricultural sector. But it's interesting to me that suddenly the US dollar is almost sort of reasserting itself as the world's sort of currency, a store currency, if you like, and the euro, after the dreadful news we had out in the last couple of days about Greece, the euro seems to be on the back foot again. Would you say that's going to be a trend that's going to be embellished?
Yeah, I think in the near term we favour the dollar over both sterling and the euro. The currency markets have largely been driven by expectations around monetary policy. In our view, the market, when Bernanke announced QE3, the market got a bit ahead of itself as it started talking of QE infinity and this never-ending, open-ended QE, etc. Well, it is open-ended, but what that tells you, there's no set end date and there's no set amount. So if the US economy starts to generate more jobs than people have been thinking about, then maybe there'll be less QE in the future, and that would be a positive event for the dollar. It was interesting a few weeks back about Jamie Dimon was talking about he thought interest rates would rise in 2013 in the US, which is certainly contrary to most people's expectations. I think that's probably a bit too soon, but we need to think about, the prospect a few years down the line that rates may be higher at some point.
At some point. For now, though, you've highlighted the fact that you've got to start looking at these alternative sources of return. Where exactly are you casting your eye?
So we think over the medium term equities will deliver better returns than fixed income because global markets are not aggressively priced. But there'll be bumps in the road. The world economy is still a difficult place, so one has to accept some volatility if one wants to be invested in equities. As part of a diversified portfolio, which we do advocate, we would look around the world to see where there are more interesting areas within fixed income markets. So we've looked at bonds issued by the likes of Qatar, for example. Mexico, we think that's an attractive bond market and currency. Malaysia is another market where we think it's not a high yield, it's a 3% yield on 5-year bonds, but in the scheme of a low rate world, we think that's a good currency and a good bond market.
What about South Africa? You're here obviously for a reason. You're not here just to have a holiday. You must be talking to people, looking for investors, looking at investment opportunities. When you look at the BRICS and when you look at emerging markets as this massive asset class and such a sort of divergent asset class, where does South Africa sit now? Has it sort of gone down a couple of notches over the last few months because of reasons that we need not talk about right now?
It's interesting. I do think, generally speaking, over the medium term, there's going to be more divergence between different countries in the emerging markets category. In the recent years, there's been they all sort of did poorly during the global financial crisis. Most of the markets rebounded. I think there'll be more divergence going forward. With respect to South Africa in particular, it's interesting being down here this week because the locals here seem much more sanguine about what has happened and less sort of the knee-jerk scared reaction that I think one tends to get looking at the press and looking from outside, in my case from the UK. I think South Africa has a number of very positive characteristics looking forwards. Clearly a number of challenges ahead as well in terms of improving education, as you mentioned before, trying to reduce the unemployment rate. I think a key challenge will be, as we look in the years ahead, to diversify the economy and try to create new industries, and hopefully industries that can create more jobs and help more people share in the benefits of capitalism.
Yeah, it's got to be difficult though. I mean, I was going through your presentation and you say most of what you observe is pure noise, and it's to focus on the process, not the outcomes moving forward when it comes to investment strategy. Just how easy is it to block out the noise specifically? I mean, you say that the headlines out of South Africa have scared investors in a big way.
Well, it is difficult because in the industry we're all subject to short-term pressures. So performance is measured over days, weeks, months, when most people's savings and investment plans might be looking 10, 20, 30 years out, and yet we tend to get wrapped up in what's happening on a day-to-day basis. And there is a lot happening, and there's lots more technology and news dissemination that creates the noise and volatility in markets. So it is difficult, but then I think one has to I think a diversified portfolio is one way of trying to get through this, because if you're too dependent on a few key risks within a portfolio or a fund, then you're going to be very nervous about what happens on a short-term basis to some of those risks. If you're more diversified, a variety of positions, then you maybe can focus on medium-term opportunities more, because you know the aggregate portfolio is not going to fluctuate so much on a short-term basis.
Tristan, just a final question from me. You talked about your preference towards equities. You think they're going to outperform. You talked about valuations not being too stretched, and that's a general comment rather than a geographically specific comment. But do you think the markets are being artificially resuscitated? I mean, it's almost like a body in ICU, which is actually brain dead, but is being kept alive by the hospitals. And it's just a question of how much money the family of the body has to keep that resuscitation going. Do you get a feeling that that's the case, or is there a genuine reason for buying markets at the moment, i.e. earnings are pretty good?
Yeah, I mean, if you look at, take the US for example, clearly we had a very severe crisis. It was the worst recession for decades. But look at what US companies have done. They've restructured their businesses, and profits have rebounded very, very sharply from that depressed level in 2008, early 2009. So that's an encouraging development. In terms of life support, I guess you're talking about QE, etc. Yes, it is a distortion in a sense, but let's think about what the authorities are trying to achieve. With no intervention, I think we would have ended up in a Great Depression scenario with widespread collapse and bankruptcies across the financial sector. So the authorities had to take action, because there is an awful lot of debt in the world. So you cure that problem either through defaulting on the debt and a sharp liquidation, which happened in the Depression, or maybe you try to manage your way out of the problem, which I think is what Bernanke and the Fed are trying to do. There's deleveraging in the wider economy, so rates have to stay low, and they do QE. And really at this stage now, they're trying to keep asset prices high, because they're trying to punish people who want to sit in cash or in US Treasuries. They want that to be painful, so that those people then either go and spend their money, or they go and buy a riskier asset, which should hopefully, the intention is it buoys the economy, wealth effect, more spending, and then we can start to work our way through some of these problems.